Jyotivardhan Jaipuria, the founder and MD of Valentis Advisor, is joining us to give us more details and more view on the market and how to navigate in this market going forward. So, Jyotivardhan, my first question to you would be, given the fact that we are seeing a clear trend of profit booking here, what is your view on the overall market? Do you expect the markets to consolidate more here, or are you just seeing this some kind of a small blip in the market today?
Yeah, so if you just step back, when I'd last come to the show a couple of months ago, that time I said the three positives and which will play out. So one was interest rates have peaked in India and probably they're close to peaking in the US. Second is, the Indian earnings were still holding up. We still think we'll end up with more than 10% earnings growth for this fiscal year. And the third was valuations at that time were looking reasonable. Now, we've seen since then, like markets go up more than 10%. So what's happened is the valuations are again starting to look a little stretched. They're not like in the comfort zone. So to that extent, I would think that, after the sharp rally we've seen, we probably enter a phase of consolidation again. We'll probably see some price correction and some time correction over the next few months.
Well, now when it comes to the Nifty mid cap and Nifty small cap, the Nifty mid cap and small cap have seen much stronger rally when it comes to as compared to the Nifty, that is a benchmark index. But what is your view now going forward? What would be your pecking order? Would you be most preferring the mid cap and the small cap indices as compared to the benchmark?
Yeah, again, if you go back to what we said earlier, then we continue to have that view that over the next 2 years, we think that the small cap and mid cap would do much better than the large cap. And the reasons are, two. One is that earnings will be better for the small cap and the mid cap relative to the large cap. They'll grow earnings much faster. And it's very quick in a economic upcycle, the large cap. And the second is the valuation relatively are looking better in the small and mid cap. They are now getting close to parity level. So I would still think from here over a 2-year basis, we think small cap, mid cap would do better than the large cap. What is possible is because the rally is so sharp in them over the last 3 months that in the consolidation phase over the next maybe 3 months, the mid caps tend to do worse than what the large cap does. So that really is the time to buy them. You have to buy the dips in the mid cap. Don't buy them maybe today, but buy the dips in the mid cap, and over the 2-year period, we'll make more money in there.
Okay, so one trend that we have been seeing for the last few days is a clear shift coming in from the private banks towards the NBFCs. So, what would be your preference? Would you still prefer private banks over NBFCs, or NBFCs would give more returns going forward for investors?
Yes, I call NBFCs like they are the typical boom and bust model. So if you see the NBFCs, they do very well when the going is good, and they very badly when the going gets bad. So now two things are going for them. One is the economy is doing well, so to that extent the NPL pressure will start easing off. Second is interest rates have peaked off in India, and once the interest rates peak, then they can start expecting the borrowing to be at much easier cost than what they've faced over the last 1-2 years. And that is the reason I think the NBFCs will probably do better than the banks. But when you classify it, it's not whether you buy banks or you buy NBFC. Both are into two different risk parameters. So that's what you have to keep in mind, that NBFCs are more risky in general. Banks are a little more secular play, and you're buying them and you can just get compounded return. Whereas NBFCs will have much sharper cycles both on the upside and the downside. But at the moment, I would say the NBFC cycle is starting to look good.
So erratic weather and unseasonal rains plus El Nino is one of the bigger risks that the Indian market is currently facing. So how do you see, which sectors would you choose or would like to stay away given these risk factors that is present in the Indian market?
Yeah, so what has happened for us is now obviously what this hurts is everything related to agriculture. So it hurts the consumer demand, it hurts agrochemical, it hurts let's say something like a tractors if the monsoons fail. So in general, if you just step back and think, for us, what's happened is we were anyway not very positive on the consumer sector, and that didn't have so much to do with the monsoon, but it had two other reasons. One is relative valuations are still much higher in the consumer sector. So if there's one space in the whole market which looks a little expensive with the consumers. The second is over the last few years, we've seen the government take a very conscious move that a lot of budget allocation is going more towards the capital expenditure and investment side rather than the consumer side. So, the relative attraction of the names in the investment plays have been much more. And to that extent, we generally not being positive on the consumer names. And I think the El Nino will make, generally everybody else also in the same camp.
Okay. IT is one sector that would remain in focus today, specifically on the back of the Accenture results coming out. So, what is your expectations overall from the sector, and do you expect that there could be a turnaround in this sector now going forward?
We've been quite cautious on IT through the last 1 year. Our whole theme has been, buy local and avoid global. And so we avoided anything which is a global name. Uh, After a long time, it's, coming on our radar. And the reason it's coming is one is it's done badly in terms of stock price. Second is the valuation are getting relatively cheaper. But having said that, we still not bought the sector, anything in the sector. We're waiting for like probably one or two negative quarters where the street gets disappointed with the numbers which come out. They get disappointed with the tone and the guidance of the company, and we think that really will be the time to buy IT.
Well, lastly, before we wrap up, what would be your top sectoral picks?
We still are sticking to more like the domestic names. So banking financial would be one area we are like quite positive on. The other's been cement, which for us has been something which we were talking about for some time now. One sector which we are getting more positive on and where we've been adding to weight is the pharmaceutical sector, where I think we are starting to see like a plateauing of the prices in the US generic. They were falling continuously for the last 5 years, and we think more or less the fall is coming to an end, and probably we'll start having a bit of turning the cycle or at least a plateauing of the cycle now.
Well, thank you for all those details and putting things into perspective.
Thanks. Bye.